And on today's show, how SPIA and DIA exclusion ratios leverage annuity tax advantages. Part 4 of this week's series on advanced retirement strategies with nationally recognized retirement expert, author, platform speaker, and adjunct professor at the American College, Curtis Cloke. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Innsmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Curtis.
Thank you, Steve. Good to be here.
Wow, I am really interested. This sounds elementary. We're talking about the power of exclusion ratios on non-qualified annuities. This should be elementary. I cannot tell you. We just did a show with Mike McLaughlin, well, I don't know, some time back, and we had so many emails. Steve, can you explain one more time, exclusions on annuities? And the reason I want you to bring this up and define it before we get going is because you're going to take a whole different, idea with some of your, what I would call proprietary nomenclature that you use.
Yeah, so, exclusion ratio tax treatment is, we actually use a different term. The term that we like using for that is first in, blend out. So let me draw a picture for you. Let's assume for a minute that I deposit $10,000 into an annuity contract today. Let's assume that enough time passes that grows to $20,000. So now let's take a look. We have a $20,000 account. $10,000 of it is deposit, after-tax deposit. Let's assume that was all after-tax, brand new money. And now we have $10,000 worth of gain. So now let's assume that we're ready for income and we just start taking a distribution of $1,000 a month. Well, because the tax rules on a deferred annuity for withdrawals require a last in, first out tax treatment. 100% of that $1,000 is 100% taxable, and I have to eat up all the gains because the last thing that went in there is the first thing I got to take out. So I'm shrinking down all my gains, and now I'm back to my $10,000 basis. I keep paying that $1,000 out, and now there's no tax because I'm just chewing up my principal basis, subject to whatever my interest rate is, of course, and now it's not taxable except for any interest gains that might have happened since the last distribution. So that's a last in, first out play. Now, years ago, before they changed the rules, 1983, somewhere in there, you used to be able to do a FIFO distribution out of a non-qualified annuity where you could take all your basis. So if I were to make the gains be on the bottom and the basis be on the top in my LIFO description I just give. So think of the bottom half of this rectangle representing the $20,000 in my deferred annuity is yellow, and the top part of the triangle is green, dark green, and it's my basis. I have to get rid of all the yellow, and when I get rid of all the yellow, it's all 100% return to basis. Flip that upside down now. So now green is on the bottom and yellow's on top. So now I'm taking $1,000 out, and now it's first in, first out. So now I'm going to get all my basis, no tax, but then when I get through all my basis, 100% taxable again. So in that example that I just gave, how much of that $20,000, what percentage of that, Steve, is basis? 50%. And what percentage of that is gain? 50%. So first in blend out says this. I put in $10,000 of after-tax dollars, it grows to 20, and now I turn on a $1,000 income stream. So 50% of my $1,000 income payment is going to be a return of my basis, and 50% of that income payment is going to be a return of my gain. And that's exclusion ratio tax treatment. Now that's very oversimplified to describe the three different methods of tax: last in, first out, first in, first out, and first in, blend out, which represents the technical term tax exclusion ratio treatment.
Now, when I'm talking about non-qualified, this is where we're talking about, and generating an income off this. You use this artfully as part of your overall tax advantage strategy, because I think I heard this from you at one of your Thrive universities. You were saying that there's so much, people don't use basis anymore. They don't use it in their thinking. They don't in their non-qualified thinking, and they don't use the application in retirement planning, and it seems to go to waste.
Well, most of the time there's a product bias to the products that maybe focus on the basis, and there's a bunch of myths around those products as well. And so we use that. They're adverse to taking basis because it usually means that I'm drilling through my principal, drilling through my assets, when really what I want to do is I want to preserve those assets. I want to live on the gains. But what they don't understand is if we can wall off a portion where in chunks of time we're taking basis and we're taking gains. And though we're technically, if we're taking basis, we're technically taking some of the original part of the golden goose, that the discount, potential discount that we get because we've shrunk the tax, we don't need as much gross income to get to the net. We can use less of the dollars over time to generate that income, so more of the dollars are not held in investments at lower maturity levels or stuck to dividends or interest yields or coupon rates, and that money can be solely focused on growth as though I'm a much younger person.
We come back from the break. We're going to walk you through he's just described LIFO, FIFO, and FIBO, right? We're going to walk you through some of the reasons why this works and why you should start implementing basis or the exclusion ratio in your retirement planning. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. Of course, we're with Curtis Cloke. Curtis is going to walk us through one of his advanced strategies in creating a bridge. Walk us through this.
Well, we're going to talk about the Social Security delay strategy using a bridge of non-qualified dollars, and we're going to use that bridge and those dollars to actually artificially lower tax brackets, depending on what filing status we have, to create opportunities for this bracket bumping Roth conversion strategy. And so I want to illustrate some facts of a case here. We actually did this in our laboratory, basically, where we're engineering all these calculations. And so here's the case study. We have two spouses, 56 years of age, and they're both going to retire at 66. And collecting Social Security at 66, the primary income amount is $1,866 for both of them. Our COLA Social Security estimate, because we're building COLA on top of the 8% increase for every year delay, 2%. Their desired after-tax income is $6,250. So we got to gross that up, given the tax specifications. We're going to actually do 1040s under the hood. We have an inflation assumption for that income need of 3%. And we're going to expect, based on the last surviving spouse, that this money's got to last for 29 years. We have non-qualified assets of $500,000. We're assuming a 3% growth rate on the non-qualified assets. We have $275 in retirement assets, and 6% is the growth rate we're assuming on those retirement assets. So I want you to see, this is just fast forwarding. Now what we've done is we've used a traditional strategy with no Social Security delay, using the non-qualified assets, the RMDs, and of course when the non-qualified runs out, we're obviously taking more than the RMDs. The income needs increase when one spouse dies because one less Social Security. And of course, you can just see that Social Security is in there. So I want you to see in this specification, what happens is at age 95, it works. It gets him to 95. But I want you to see if that last spouse lives longer, we're out of dough. This is the traditional strategy. Okay. So now let me show you the alternative. So first in blend out, we've talked about that. Okay. We haven't talked about this one, but we'll probably come back. But I'm going to introduce it as, this is the FIFO FIA contract, where I put money in and it's going to roll up and I'm going to have a guaranteed income stream, but I'll have no added benefit, no credit to my initial deposit that I put in a long time ago. But I got a lifetime income or a joint lifetime income, and the first few years I turn it on, it's a FIFO distribution strategy. Watch what happens when I put these together. So we're going to allocate $150,000 to the DIA that gets the FIBO tax treatment, and the exclusion ratio on that contract is going to be 90%. We're going to put $200,000 in the FIA that gets the FIFO tax treatment for the first 5 years, and you're going to see that we're going to have yearly Roth conversions from 65 to 69 of $100,000 a year. And I want you to see now what we're going to do is we're going to create this Social Security bridge using the FIFO FIA, the FIBO DIA, the restricted spouse Social Security filing. So now we're maximizing Social Security, our non-qualified assets. So you can see our FIBO DIA is down here. It's just a 5-year payout. Our FIFO FIA, in the bridge, it's tax-free. Out of the bridge, it's 100% taxed. we're going to pay a bunch of taxes, but we're doing it in the compressed tax bracket, and we're going to convert those dollars to Roth. We are going to eat up our non-qualified dollars. I want you to notice how small and how much control we've created over the R&D requirements, because there's just not a lot of qualified left. So we've supercharged this Social Security. Look how much more Social Security benefit is.
Because of the delay.
Because of the delay. Now watch the result of this. Now we've actually talked about the bracket bumping. I'm going to skip this slide. I want you to see this. The only thing that we did between the original strategy and this strategy is we used a FIFO-FIA and a FIBO-DIA to maximize the tax efficiency and did the Social Security delay. That's all we did. All the assumptions are exactly the same, but instead of having our money out at age 95, we have $1.8 million at the end of the day. And I just want you to see the power. Now, we could improve on this substantially with QLAC other opportunities, but my point to you is that just by doing those two vector changes at the fund of retirement, massive amounts of efficiency are created just with those two strategies.
Okay, so to make sure I understand, that delay, those two little tactics with the same money,
yes,
were able to bring you out all the way past their life expectancy and have cash at the end.
That's correct.
Which in the other place, they ran out of cash and they had no capital at all.
That's correct. You know, and because the income stream from the FIFO-FIA, it's still fully taxable, but it's for life. It's an income stream you can't destroy, and it's one you cannot live. And of course, we haven't talked about what we do with all those Roth assets that are actually financing the income based on our assumed rate of return assumptions. But we can guarantee how we position those dollars, those income streams, and inflation. In addition to that, I just wanted to keep this as simple to understand as I possibly could.
Before we leave the show, Curtis, how many advisors know this tactic?
This is brand new. This is something that we recently discovered ourselves, and it's something that we've put together and we've actually tested in our laboratory, these case studies. So we have every jot and tittle of all the math, the science, and all the calculations that are implicit in this case study. But this is amazing. We just want to put this out there in front of the financial professionals and say, you know, there's little small vector tipping point changes that you can do. Do they take time? Yes, they take time. Do they take a little bit of expertise? Are you just going to be able to go in and click a quick program and get a quote and go out and make the sale today? Maybe not. Maybe you're going to have to wait a couple of days and get some analytics down. But the power that's equipped in your hands with all these new tools are amazing, and you just got to pay attention to them. Now, Steve, watch this. Look at the differences. Now, you'll see that the baseline of doing the traditional way is in red. And you can see that the Thrive plan in our case, you see that there's a dip, but this is the bridge. You know, that's the period where you actually had a little bit more liquidable assets to utilize, but it doesn't. This is an asset chart of what the assets are actually doing. But here's the biggest difference. If I take a look at what my balance is under the baseline approach at age 95, I got $87,000 left. I have $1.8 million, as I just showed you, at 95 using the Thrive plan strategy. And your taxes that you pay under traditional is about $329. The savings of taxes by just changing up those two different levers is 109, significantly less taxes. This isn't a rate of return story. This is a tax efficiency story. And look at the Social Security benefit by bridging that Social Security and optimizing that, even with restricted filing. 2.6 versus a $3.2 million. This is extremely efficient and very powerful, and we should be incorporating it in our traditional planning.
Wow, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.